Hello and welcome to my trading basics video revolving around the topic of a stop loss order. So when you're around at the stock market and you probably know about the stop loss order. So I think all brokers offer it. So basically when you buy an asset, you place you can set up a stop loss sell order to sell your assets at a given price that either you specify or gets trailed within the stop loss. So that's a trailing stop loss, but I will get to that later. Also, there's a difference between the usual stop loss order and the stop loss limit order. In the usual stop loss order, you just define the price. So when the price, for example, I bought Euro US dollar, a certificate or something at 110.202. I placed my stop loss at 110.128. I just use a stop loss order. My stop loss gets triggered and my assets go into the market with a best order. That means they get filled instantaneously, but you don't necessarily get this 110.128 price, but it can be a worse price for you, so that's not so good. And that's when you can lose a stop loss limit order. You can set it up once it reaches 110.128, and you place your limit at 110.128. That means you also only want to sell it for 110.128, but then in turn you have to have market participants that want to buy it for 110.128, and sometimes your stop loss doesn't get executed right away, and since you're relying on the stop loss, this can be bad for you. And yeah, you just have to basically find the right way for you how to use those, but that's basically the difference. So when you just use a stop loss order, it just gets filled with a best order, and if you use a stop loss limit order, you can specify a certain price additionally to the stop loss order at which you want to sell your asset. Basically the stop loss order is meant to, as it's called as well, to prevent you from losing money, so to prevent losses. And that's what you use it for. So if you're a trader, it's of critical importance. You have to use stop loss orders whenever you buy an asset, just to secure yourself and cut your losses, basically. Because when you're a trader, you're aiming for good trades, and the prices can always go into another direction than you anticipated, and you can always be wrong. There's always a possibility, but you should be right as often as possible. And but you never know if you're right or not, so that's why you basically use a stop loss order. So when you typically when you enter a trade, this is the high risk period. So that's the time when you can lose money, and so that's why you have to wait for the right moment. So in trading, basically, you do a lot of waiting, weeks, days of waiting, trading nothing. And then there's the right moment, you trade, you place your stop loss, and then you wait again for prices to go into a certain direction. And sometimes, or more often than not, it takes weeks, and it's actually quite boring sometimes, but it's just part of the game, so to say. And that's just how it goes. And when you enter a trade, you would want to place your stop loss accordingly, just to cut your losses. And because if prices go into another direction, you want to either rethink your stance on a certain asset and maybe see if you were wrong. If you're an Elliott Wave practitioner, you maybe want to recount your wave count, or you want to adjust your price targets, and those things. And just maybe you can use your money in another asset better than in this asset where your stop loss got triggered. But you have to find a strategy which works for you to define where you put your stop loss. Typically, you could just place a stop loss below a significant low like this. For me personally, the Elliott Wave theory is very good in determining turning points and where to place stop losses, as the rules always define where the prices will go and where they cannot go, or you have a wrong count basically. For example, if we have this movement, this 1, 2, 3, could be a 3, 4, 5. This move up, so we had this huge move down all the way here, and basically you're waiting for a turning point. And what I typically do is I wait. So I wait for movements like this, where there's an impulsive move to the upside, and then for a confirmation. So this has to be bought at some point and gets back up to higher prices again. And if this previous low gets broken, typically there are lower prices to come. It's not always the case, but depending on the count that you use or the method, but still this, yeah, that's what you use your stop loss for. So when even if you think, okay, this looks bullish, I want to trade this, you enter a long trade here, you place your stop loss ideally below this low. There you were lucky, maybe it won't get triggered, but there it got triggered, and even if it goes up one more time, don't be mad about it. I mean, this move down came and all the way down again. So right now, this would have been a good time, obviously, to have bought Euro US dollar, just for example's sake on this Euro US dollar chart, the hourly chart, just to show some things. Basically, this obviously would have been a good opportunity to buy. Very bullish, 1, 2, maybe 3, 4, 5. You can count this as a 5-wave impulsive pattern, ABC correction, which got bought immediately. So this is typically the moment where I say, okay, I can enter a trade and place my stop loss below this low. So then prices go up ideally, and we get this further pattern, another correctional low. So I can maybe adjust my stop loss up to here once this is over. Then we get another correctional low with a big impulse up. I could trail my stop loss all the way to this price area. And basically when I have this stop loss here, I'm already in profit. So from then on, I only manage profits, and that's what the stop loss is for as well. So it's not only a stop loss, but it's also a securement method for your profits, because when you're not around, prices can plummet within half an hour or an hour, and obviously you want to sell at a certain threshold, and that's what the stop loss is also for. And yeah, then I would of course trail my stop loss accordingly, maybe place it here. This movement goes up, so I could count this as 1, 2, 3, 4, 5, a 5-ish pattern. So this could be viewed as an impulse, but then again, if I use the extensions, this being a 1 and this a 2, the 3, which I think this looks like a 3, maybe this is the top of a 3, should ideally go to this 1.618 extension, which it doesn't right away. So either this is the top of the 3, but this is an unusually deep 4, and even here goes into the price range of the 1. So this cannot be the 3 in total, and this cannot be the 4. So A, B, C, 1, 2, no, this goes in price range of this. So this cannot be the 5 either. So essentially, you would have to rethink your count at this point. But nonetheless, you had your stop loss here, you made a good trade, and yeah, I mean, those insecurities and where the market is are always present, and you never know what the market's going to do next. It is always just a best guess. So this is why it's so important to use stop losses, on one hand to minimize your losses when you enter a trade, and on another hand to secure your profits when you're in profit. And your goal should be obviously to get your stop loss in profits as soon as possible, so you don't lose any money, because trading, as I said, I think in my 3 most important aspects of trading's video, trading is all about being consistent. Even if it means you only make 0.5%, 1%, 2% profit per trade, you're still making a profit. And even if you do 0.5% or 1% per trade and you do those profitable trades with 1%, 300 times, you're still off with a really good profit, as those profits accumulate and they generate more profits exponentially. And yeah, but how can you determine a turning point? So I'm this Euro US dollar hourly chart, and usually what you want to do is don't buy into lows. So always wait for confirmation first. At least that's what I like to do. Of course, you can do this and be lucky and catch the low. But imagine looking at this and you buy every low. So you buy this low, oh, not a good trade. You buy this low, not a good trade. You buy this low, not a good trade, because you don't wait for confirmation. And every time you lose 1% money, I mean, you do this 100 times, you don't have any money left. So that's ideally what you don't want to do. So you always want to wait for some kind of confirmation. So this right here, it's a very good impulse and a correctional pattern. And when this is over, this is a very good indication for a trade that is highly likely to be profitable. Of course, no guarantee, because you can always be something else and it just goes down. But the chances of it being profitable around here are very, very good. So right now, just to give you an example, we are in this downwards movement. So this is obviously an A, B, C correctional pattern. Last week I entered a long trade around this price area as I waited for this 5-wave A, B, C correctional pattern to finish. And at first it looked good, went all the way up, but then down again, and around here when nearly all of this previous candle got sold, this didn't look very impulsive going to the upside to me, so I sold around here with a minimum profit, which was really almost nothing, but still I didn't lose any money. And I waited just for the prices to unfold, and yeah, as it turns out, I was right. I mean, there was one more high, but I'm not mad about this since prices now have plummeted. And yeah, I'm currently waiting for this downwards move to finish for the next chance to buy a long trade. But it's a very close call. I mean, prices went very low already, but if we count this A, B, C, this is probably another A, B, C correctional pattern. This I would see as a 1-2 of this C downwards movement. So we have an overarching, this is a larger wave A correctional pattern. This all is a B, and this is probably the C. And if I use just the extensions, place them down here and there, we can see that the 3 of this downwards movement, 1, 2, 3, should ideally go to this 1.618 extension. It did. It just barely touched it. And then probably this is just the 4 of this downwards movement. And then this is wave 5 to the downside. So I'm not entirely sure where this wave 5 will stop, but to me this indicates that I need to have a closer look over the next couple of days on the prices for this asset. And once I see prices stabilize, if I want to take a risk and I have too much money or something, I don't care about losing 1%. I could just use the first bullish sign to buy this and catch the whole movement. But usually I don't like to do those trades because in the long run they cost more money than they offer, and it's always, in my opinion, better to wait a couple of days for confirmation, not get the best entry, but be sure that you are trading in the right direction. So what I would be waiting for is obviously just the finish of this wave, and then we would get another at first a small 1, 2, 3, 4, 5 impulsive pattern, which obviously would go into a larger degree of, this is all a 1, a 2, 3, 4, 5. And so basically when this pattern and this 2 is confirmed, so we get a new low, this is the time where I have my eyes on the asset more regularly, just to to get this entry point, and then obviously once I know where this low is, place my stop loss right below this low, and yeah, wait for the rest of the trade to unfold, and hopefully it's going to be profitable. If not, I have to wait for the next opportunity, because obviously there's always a next opportunity. But this movement is as well interesting because we have this. It looks very impulsive to me because it's clearly dividable into 5, but it's on the other side. It's so maybe we have a 1, 2, and this is just another 1, 2. But then again, this 2 went below this low, so this cannot be a 2 either. So maybe this is just a 1, 2, 3, 4, 5, but a very weak one. I'm not sure about this, but either way, as long as this threshold is not broken, you're still at a somewhat, I wouldn't say bullish picture, but the price movements point to the upside. And I mean, if you had to look at Euro US dollar for a longer period of time, you can see that there's been some movement, and this clearly is 1, 2, 3, 4, extended 5. So this clearly gets, you can divide those into those movements into a 5-wave pattern. So this would mean that right now we are in a, this is the 1, A, B, C. Ideally, this is the lower of the 2. And this should be the start of a 3, but then again, the 2 can always go lower, and this can just be another part. This can also be an X wave, because X wave very often get mistaken for another impulse, but they just correct and they just connect this previous correctional movement to another correctional movement. And yeah, so again, you're never sure about the next price movements. You can never be sure, but all in all, the price movements in this asset right now look very promising. And I mean, we had this low down here, which was at 110.8774, and yeah, then prices were very impulsive. I mean, we got up to this point actually, or to this price area even. So this means there's at least some kind of buying interest. And yeah, it's very exciting to see where the Euro US dollar will go, if the Euro will get stronger, if the US dollar will get stronger again. And yeah, right now I'm just waiting for this to finish and then enter a long trade at some point and place my stop loss accordingly. And yeah, once we are out of this possible loss phase, just move my stop loss into profits and then just manage profits and keep an eye on the asset every now and then, just to trail your stop loss accordingly and secure everything. Okay, so I hope this was helpful to you, and thank you very much for watching, and see you soon.